Welcome, everybody, to the Brian Fultus Behavioral Finance Podcast. My name is Dr. Brian Fultus, and I am an associate professor of finance at Butler University in Indianapolis, Indiana, USA. And my goal is to teach you about the area of behavioral finance. Today, we are going to finish our second section of this more or less course/podcast that we're starting out here. And today's topic is going to be overconfidence. So I usually, before bringing out the name of the content, I will bring out this survey. But regardless of whether or not I introduce the topic before the survey, the results are always the same. And we're going to get to that in just a moment. So thank you very much for watching today. And if you haven't already, please make sure you like and subscribe to this channel as we follow along this comprehensive course of behavioral finance, as we're just getting started with this content and all of the topics that we're going to be able to talk about through this channel and this podcast. So thanks again, everybody, for watching or listening. And my apologies in advance if you're listening to this particular one, as there are going to be just a couple of visual hints or visual aids for this that will be, I guess, enhanced by the YouTube viewers. But that's okay. Everyone's going to get through this all together. But the other part is this survey that we're going to do. So the survey, you can actually find this on the show notes. I will have a link that'll go to my website, and that'll download the link. There shouldn't be any malware or anything like that on these links. They're simply going to be a Word document or Word adjacent document that you can download and take a look at this survey. But anyway, here it is. I'm going to ask you 10 questions. And for each of the questions, I want you to provide a numerical range that you believe that you are 90% sure contains the correct answer. So that means, obviously, if you don't know, then you want to put a large range, but you want to be 90% confident. That means if you are doing this correctly and are calibrated correctly, 9 out of the 10 answers should fall within your range. Yeah? So it should be pretty clear, right? Your goal is to get 9 out of 10 and to have it fall in that range. So I'm going to ask you 10 questions and think about your answers. Number 1, what was Martin Luther King Jr.'s age at death? Martin Luther King, MLK Jr.'s age at death. Number 2, what is the length of the Nile River in miles? Number 3, how many countries belong to OPEC in 2022? Number 4, how many books are there in the Old Testament? Number 5, what is the diameter of the moon in miles? Number 6, what is the weight of an empty Boeing 747 in pounds? Number 7, in what year was Mozart born? Number 8, what is the gestation period of an Asian elephant in days? How long are they pregnant? Number 9, what is the air distance from London to Tokyo in miles? And number 10, what is the deepest known point in the ocean, any ocean, in feet? All right, so if you're playing along, you're going to put your ranges for either all 10 of these, and your goal is to get 9 out of 10 correct. So if you need to pause me, you can pause it and resume this when I give you the answers coming up here, because that's what we're going to do. And you go ahead and tell me how you did. You got to correct your own answers, though. All right, ready? Number 1. Martin Luther King Jr.'s age at death, 39. Number 2, the length of the Nile River in miles, 4,187. Number 3, how many countries are in OPEC? That is 13. How many books are there in the Old Testament? That's number 4. The answer is 39. If you are Catholic, we'll give you 46. Number 5, the diameter of the moon in miles, 2,160. Number 6, what is the weight of an empty Boeing 747 in pounds? 390,000. That's usually one that gets a lot of people. In what year was Mozart born? Number 7, this is the year of 1756. Number 8, the gestation period of an Asian elephant in days, 645 days. Number 9, the air distance from London to Tokyo in miles, 5,959 miles. And number 10, the deepest known point in the ocean in feet, and that's the Mariana Trench, 36,198 feet. All right, so add up the number that you got correct out of 10. And if you're brave enough, you can report those in your comments. Let me know how you did. I have the average for my most recent class. It was actually one of the highest that I've received since I started teaching this class. And that average was 3.94. 3.94. And I thought that I was very clear about the objective of this particular survey. And I hope I was. We're trying to get 9 out of 10. Seemed pretty easy enough. Just make it, if you don't know, just make it wide enough that you get 9 out of 10. Yet every time we systematically fall under this, with many people getting 1 right, 2 right, a majority getting 3 or 4 right, and then very, very rarely is somebody going to get 9 or 10 right. Now, of course, you get one person that says 0 to infinity on all of them and then bombs 1. I mean, you could do that theoretically. But many of us, if we're really applying ourselves and trying, we're going to get about maybe 3, anywhere from 2 to 4 correct. And say, okay, all right, what the hell are we doing? Where are we going with this? Well, I already told you. This is our overconfidence survey. And this shows us that we have a tendency to be overconfident in our calibration and how we make estimates and what we believe about what we know and what we feel like we want to know. And so as we break this down, we want to delineate between these two. Confidence. It's great to be confident. Having a positive feeling about your skills or knowledge, etc., is generally a very healthy thing. It's a good thing. Believe it or not, it's something that I had struggled with, and self-confidence and really believing and talking to myself positively. And man, once you start accepting yourself and talking to yourself positively, like I would talk to other people, hey, good job, you worked out, good job, keep going. Then confidence comes along that you build internally on your own. You start believing it. So anyway, that's been I'll talk more about this mental health journey this year that I've been on. It's been quite extraordinary. And all this to say, though, that confidence is generally a very good thing. And this is just simply having a positive feeling about your skills, knowledge, etc. Now, overconfidence is an inflated sense of this ability, of your own abilities that go beyond reality. So this inflated sense. And this is where you can get in trouble. Now, we probably see some guys at the gym or walking around going, oh man, there's overconfidence walking around. He needs to come down. Try not to judge. This is in our own financial decisions and our decision making. We're going to talk about where our overconfidence can kind of hurt us in some different areas. So what we saw here, there are 4 different manifestations of overconfidence. The first one is what we did in our survey. This is called miscalibration. Thinking that our knowledge is more accurate than it really is. And in number 8, I said the gestation period of an Asian elephant. The reason I said that's how long they're pregnant is because I had to look that up at some point. It's like, what is that? I should know this. I don't know. Also, OPEC, the Operation Petroleum Exchange Countries or something. Like that's, I thought I knew what OPEC was, but I didn't realize that it was the petroleum countries like Iran and Iraq and exporters. They're the petroleum exporters. That's what OPEC is. So again, I always think I know these things, and it's going to lead me to really shrinking down these the ranges here. The weight of an empty Boeing 747, if we were honest with each other, we would really have no idea what this would be. But we tend to get that one wrong in many ways. Same thing, our knowledge is more accurate than it really is. At some point, I'm sure I studied when Mozart was born or when he was around. But truthfully, I have no idea. I need to put a larger range for that to get it right. So again, miscalibration is that first manifestation. Number 2 is called the better than average effect. The better than average effect. How many of us feel that we are smarter or more skilled than average? If we're in class, say, hey, who do you think is, show of hands, who is above average driver? Majority of the hands go up. Who do you think you're going to do better than average for the class? Majority of hands go up. And this is what we always think, always better than average, even though we sometimes don't even know what is an average driver. I know for certain I am not above average. I'm a pretty bad driver. I ain't gonna lie. Overconfident, that's how it manifests. Another manifestation of overconfidence is what we call the illusion of control. Illusion of control is when people think they have more control of an outcome or an event than they can objectively be true. We believe we have more control of an outcome. Now, if we were really being honest with each other, how many of us wear, a lucky hat for your team or lucky colors or do something in order to support your team and thinking that that's going to make them win the game? Or for me, it's the opposite. If I wear the team colors or the team logo, that means that's the kiss of death, and do the opposite. So I'll go to the game in different colors. I know, but hey, I'm just being honest, and I know a lot of people do it too. This is an illusion of control, feeling that we did this. Oh, I changed my seat on the couch and my team scored 3 touchdowns in a row. That's because I moved the seat and I just aligned the universe just right for this to work. I had the control of this. You see where I'm going. Overconfidence. And then finally, we have excessive optimism is another manifestation of overconfidence. If it's great to be optimistic, just like confidence is good. This excessive optimism, if we predict the future unreasonably or unrealistically optimistic, then we're either setting ourselves up for disappointment, a loss of self-esteem, reduced social regard, some of these things. And And then what ends up happening is the inevitable quitting. And so when we talk about this overconfidence, we get, and when I'm dealing with college students, you get people, some might have really ambitious goals, and you don't want to stand in the way of those goals. And I've got ambitious goals, and I want to accomplish things in life and set goals. And what I'm learning over time, though, is, this is what Bill Gates said. He said, we can achieve way more than we think over 5 years, but we tend to achieve way less than we think in 1 year. So we have these ambitious, overly excessive goals for 1 year, and then we fall short. And when we don't see the big picture, we end up getting discouraged, and we stop the whole thing. Where if we had a longer term and more reasonable goals and see, hey, I'm going to just move the needle every day, and then I've got 5 years, see how this plays out, that tends to lead to more long-term success. So we've got this overconfidence, and every class I've ever had falls way under the goals. And we talk about the manifestations of overconfidence. Now I've got one final visual representation to show you. I have 2 pictures here, and I've cut them out, and I'm showing you on the video. And I want to show you that one of these pictures out of the 2 is a bucket of water. And the other picture is a bale of hay. So a bucket of water and a bale of hay. Now, I want you to choose which one do you think is the bucket of water and which one is the bale of hay. So my apologies if you're listening. Thanks for listening. Please give good feedback. All right. Now, I'm going to ask, once you've decided here, which one is which, bale of hay, bucket of water, I want you to give your confidence level. How confident are you in this? And this is where I would love to be in a live room for people to see. And I get to watch them kind of like squirm a little bit, because they want to be really confident, and but they know I've just spent the last 15 minutes messing with them on the overconfidence, so you don't want to go too high, because y'all did terrible in the survey. And so we usually get some high 90s. I want to feel like this, but never, the 100%. And let's just be very clear. I'm not messing with you here. This is a bucket of water, and this is a bale of hay. There's no need to overthink it. But in the context that I've had this, we're talking about overconfidence. When tasks are extremely easy, we can be underconfident. So now, when we have a task that is a little bit more challenging, type 2, that's going to usually be the area that we have our overconfidence, and all these things lead to overconfidence. When we have easy tasks, the opposite happens, and we start seeing underconfidence, and we start overthinking and questioning things for these easy tasks. So sometimes we need to delineate between easy tasks and hard tasks, between these two things. Who is most overconfident? This is many studies across the world that have shown this, and I've come up with 3 main drivers of overconfidence in our own estimates, and then also in financial decision making as well. And you don't have to look much further than the person talking to you and standing here, because number 1, males are more overconfident. That's probably not too surprising for many, many people. Number 2, though, more education. So if you have more education, higher level of degrees, do you think that's going to lead to higher overconfidence or lower overconfidence. And what we found is those with higher levels of degrees, advanced degrees, the higher you grow, the more overconfident you become. And that was driver number 2. The third one is better at math. So if you have good numerical skills, do you think you are going to be more overconfident or less overconfident? Well, if you're better at math, you're actually going to be more overconfident in your assessments. And so I start thinking about this, and you tell me how you think about this as well. But as I'm looking at these estimates, I'm constantly in a struggle with my own brain and my own ego. And in the back of my mind, I'm going, hey, look, you should be good. You're good at math. You should be able to make an estimate really well. So when Mozart was born, you've learned this before, and I'm going to make a nice, it's got to be somewhere in a very small range, because when I get that right, I'm going to feel so good and so redeemed about this. But I have a tendency of thinking, okay, well, no pressure, but you've got your doctorate. You teach this shit, like you should know, get this right. And that leads me to actually a narrower range. Instead, what should it be is, look, I need to understand I don't know this. I understand that I'm overconfident. I need to give myself more slack and have a larger range, knowing that I don't know everything. You have to kind of get past that. But those 3 main areas, males, advanced degrees, good at math, they're going to lead to more overconfidence. All right, why we don't learn. It's our next section, and you should think that, hey, we learn about overconfidence. We should be able to step in and understand this. This is a tough one to override. Some of these other biases that we talk about, one of the main reasons that we lay these out one by one is for us to build an awareness of the bias. And when we are aware of it, first, that's when that type 2 thinking can come in, tap us on the shoulder and say, hey, I need to step in right now and override this decision because of this bias or heuristic that we've learned is negative. But with overconfidence, there's some reasons that we don't learn and override this. So number 1 is called the self-attribution bias. Self-attribution bias means we embellish our triumphs and we forget our defeats. So we embellish the triumphs, forget our defeats. So it just continues this overconfidence, that loop that we don't really learn from. How many of you have, when we talk about investment stories, say, oh, well, I had the stock and I bought it at $1 and now it's, through the roof, or the one, the person who bought Apple back in the day and now it's at this, or the person that bought Bitcoin, now it's at 30,000 now, even after its dip. And so, I bought all this and so we really embellish this and tend to forget that, I'm not going to necessarily say that I went in and bought more Bitcoin when, it was at 60,000 and I basically erased any gains that I had from being here early or whatever. And so when we were trading at Fidelity, where I was working on the phones, sometimes to get a trader to trade more, we would talk about, say, hey, what was your biggest stock gain that you've ever had? And see if you can get the trader to start talking. And this is their self-attribution bias, where they will really embellish some of their triumphs. And then it kind of opens up the door they'll say, hey, I've got money somewhere else. And that's where you try to recruit them to come in. That was part of the game. But anyway, embellishing our triumphs and forgetting our defeats. Number 2, it's called the hindsight bias. And this is where we say, if you ever hear, I knew it all along, something was going to happen when we really didn't. Oh, I knew this was going to happen all along. This hindsight bias, it says, well, I knew that the crash was going to happen in the financial crisis. And we have many people said, well, I predicted this crisis happening. And say, okay, well, how much money did you gain from being right? Well, I just said it was going to happen. I didn't actually trade on it or do anything around it. It's like, okay, this is hindsight bias. The fact that you said, I predicted this, I knew it all along, didn't make any money around it, say, okay, yeah, I knew it too. But this is, again, I knew it all along when we really didn't know it was going to happen. And then finally, the confirmation bias, again, is always getting in the way of our learning because we're just constantly seeking out this information that will confirm either our overconfidence or our biases and not giving us that opportunity to have a little cognitive dissonance and learn around it, or be more to actually know ourselves and to understand ourselves better. That sometimes is a process that resembles this cognitive dissonance. It's not always fun. It's not always pretty trying to learn about ourselves and understanding, hey, I'm really overconfident. I need to know when to step in and to moderate my expectations on how things are going to play out. So, by the way, the cryptocurrencies, I guess call me old school, call me old. I do not invest in that. I've had it explained to me many times from a lot of really smart people, and I never understood it, or I never quite got it. So I haven't invested anything in that. And I just follow the old Warren Buffett adage where they say, don't invest in things you don't understand. And until I understand it or have my questions answered, I'm not going to invest in that. So I do believe that there is some opportunities through this blockchain that is here to stay. And if you do feel really emboldened to want to be in the crypto space, then I would say, hey, that's fine. Use it as a diversifier. So you want to put 5 or 10% in your overall portfolio in this space. I'm okay with that. But if we get too heavily invested in this area, this is unnecessary risk. And all of my issues with this have been the way that it was always brought to me was, oh, well, it's so secure and neutralized. And I said, well, okay, well, what about the hacks that have happened? Oh, well, then it's like, okay, well, it's not totally secure then. So, well, it's unregulated and not centralized. Okay, well, tell me, how is the not regulation working? It seems like it's the wild, wild west on steroids with FTX and all that. Who knows what else is going on when nobody can actually regulate it. So tell me how that's more secure. Oh, wow, it's stable. It's like a current. Okay, well, it's bouncing around more than any asset I've seen out there. I don't even know what I guess I don't know what I would even compare the beta to, but it's got it. I mean, I don't even know what the volatility on that is compared to anything else. I just know I've never seen anything as volatile as this cryptocurrency space. So, no, thank you. I'm out. So, anyway, whenever I see this self-attribution and hindsight bias, confirmation bias, I always think crypto, and you see people online, oh, I made all this money on this, and I'm just like, oh my God, people, please, let's stay away. Be reasonable. I'm not a financial advisor giving you advice. But we're trying to learn about better financial decisions, and let's have a diversified portfolio. You need help, let's find an advisor that's fiduciary that can help you, that's aligned with your interests. We'll talk more about that later. Anyway, overconfident traders. So when we talk about financial decision making, let's bring the overconfident people into the world of finance. And what we find is not only are personal investors what Werner de Bont called a sorry picture, which I always find a great way in 2 words to explain retail investors and our decisions, sorry picture. But overconfident traders are one of the worst bunches. So, they do 3 things. Overconfident traders do 3 things. They trade more. Okay, so more trading used to be that's more commissions that they would be churning and paying out commissions. Now there's still tax implications, short-term gains that they would be taxed on by trading more. So there's some negative ramifications of that. They earn less. They almost undoubtedly underperform the benchmark of just buying and holding. And so this is why we find females do a lot better than males, because males like to tinker and fidget, and females have a more sensible approach, which just keeps them more in line with the benchmark, which is the market. And the guys with all their tinkering always underperform. And I'm not saying 100% underperform, but that number is about 90% underperforming. It's very rare that anybody will overperform. Moreover, overperform consistently. So, and then at the third point, they're the least diversified. So you would think if you're trading more, you'd have all of your eggs in different baskets, but they're not. They're actually too consolidated in either one or a couple of different individual stocks, or they tend to glom towards one industry. And so in one particular market. So in all these different ways, they're missing out on the opportunity of diversification. So they trade more, they earn less, and are the least diversified, these overconfident traders. And then finally, we have analysts and excessive optimism. So this is where our analysts come out and give their recommendations for stocks. And I'm going to give you some homework. I would like you to come up with stocks that have been battered pretty recently. So I know from owning it that Intel, large corporation, Intel's been kind of just a dog. And every time they talk about it on CNBC, Jim Cramer just cringes. And you can say what you want about him, but I find him entertaining. So anyway, I've got Intel here, and earnings per share is now negative. They lost 71 cents. They're still paying a dividend with a dividend yield of 1.37. And I don't see a ton of good things that anyone has said about them, but let's see what the recommendations are here. So I'm on Yahoo Finance, and I'll just pull up the quote, and I've got, it's called Analysis. There's a little tab here, and I've got the earnings quarter, and then there's a recommendation tab. So as of May, there were 43 analysts. Actually, no, here's June. 41 analysts making recommendations here. 5 give Intel a strong buy. 18 are a buy, 13 are a hold, and then you have the rest, 31, 36, 3 say underperform, and 2 out of 41 say sell. All right, so 5 say underperform or sell out of 41, hold 13, and then 23 out of 41 say this is a buy or a strong buy. This is one of the most downtrodden stocks that are out there. If we look at Tesla, which I know Tesla is trading at about 75 times forward earnings. So essentially people are paying $75 for every dollar of current earnings. They're not paying a dividend. The beta's 2, so highly volatile. Earnings per share is 3.47. Let's see what are the recommendations. By the way, you can actually just scroll down and see this on the first page. It's called Recommendation Trends. I'm looking at May, and it looks like there's 21 out of 43 saying keep buying or strong buy. 17 say hold. 2 say underperform, and 2 say sell, or 3, I think. So it's not as positive as I thought, but again, this is a company that is fairly highly valued at the moment, and they're still saying buy, buy, buy. What about... So I get down a bunny hole. I don't know. I hope I'm speaking to the right crowd here. Here's Apple. So Apple had 38 recommendations in the month of June, and 11 of them were strong buys, 21 were buys, and 6 were holds. 0 underperform and 0 sales. So the topic that we're talking about here is called excessive optimism. And so when we're looking at these analysts, we have to see this with a grain of salt. And not just a grain of salt. You better just take the whole thing of salt. It's a bucket of salt that we need to take this with and understand that there's a reason that these analysts are overly optimistic. And the way I read that chart is strong buy is a buy. Buy is a hold. Hold is an underweight. And anybody saying underperform or sell is you better run for your life. So if you can read it that way, that's actually more realistic. But if you're an analyst, you have to think of some of these conflicts of interest that would lead to this excessive optimism. Okay, so think about if you're an analyst and your employer and you're analyzing a company, you've got some conflicts here. So first, if you're an analyst, you want access to the C-suite, so you can talk to the CEO, CFO, C whatever O, to get information to make your recommendation, and as well as all the other public information that's out there to make so you want access to that. If you're hammering this company with sell recommendations, they're going to cut that access off. So that's one reason why you would want to give them the benefit of the doubt. Number 2, though, it gets more to the point. You want to have banking relationship availability for funding for these publicly traded companies. So if I'm at Morgan Stanley and I'm a stock analyst for them, and I'm kicking whoever's ass, Apple here, I'm the one sell order, and everyone else is saying buy or strong buy, and they're looking for a stock or a bond offering. Hey, I need to raise a couple $100 million for this next bond fund offering, whatever. Banking relationships. Who do you think they're not going to go to? Of course, the ones that are hammering them. So they want to have a positive relationship. They're going to give them good reports for just the fact that they want to do banking relationships with them. And then third is this personal career risk. As an analyst, you don't want to be against the crowd. And there's that aspect as well. But you lay all those three things out, you get a great explanation as to why these analysts are excessively optimistic. And frankly, you don't really find, because of this, you don't find a ton of real good value, unfortunately, from these recommendations, or at least I'm not able to interpret much from that. So anyway, friends, we are done with section 2 of the course if we were going through this, and that's what I said we would do. We would just start the first few podcasts as the course would go on. So we're essentially 2/3 of the way done with the course. I'm excited to continue on and to build more content into this area that I find very fascinating and love to talk about. And then from there, we're going to start addressing some other topics that build off of this content. So there's a method behind what's going on here, and I look forward to carrying that out. I hope you enjoy it as well. So thank you so much for watching. You need to contact me if you have any questions, any requests. Please let me know. You can find me at brianfoltis.com. Find me on Instagram, and see where else I'm going to be able to pop up. But also make sure you like and subscribe to this particular channel, or if you are listening on a podcast, I think I'm on a lot of different platforms. I would be more than thankful if you could give some good feedback on that, as it helps boost and promote this channel in order to assist more people in learning about behavioral finance and hopefully making better financial decisions. So with that, I thank you one last time and hope you have a great rest of your week, and we'll see you next Tuesday.